Once again, we continue with Law You Should Know. From the Mineola Law Firm of Shane, Dox, Denise, Corker, and Sauer, here is attorney Kenneth J. Landau.
Hi, this is Ken Landau, and welcome back to Law You Should Know. We're continuing our discussion about the tax consequences of owning, buying, or selling real estate. And our guest is Barry C. Levittan, and he's a partner with the CPA firm of Rosenblatt, Levittan, Volfus, Getz and Company in New Hyde Park, Long Island. Barry, you've told us about some of the tax consequences of buying and renting and owning property. When someone is selling property, what are some of the tax consequences?
Okay, so here you have some very interesting tax consequences. First, on the sale of your principal residence, if you've lived in and used that residence as your primary residence for 2 of the 5 years preceding the sale, you get to exclude from income a gain up to, if you're single, a gain up to $250,000, and if you're filing a joint return, a gain up to $500,000. So you could have bought a house 30 years ago for $100,000, sell it today for and put improvements in it for another $100,000, let's say. So your cost is $200,000. You sell it today for $650,000, and you're married. That gain is $450,000. There's no tax to pay on that. It doesn't matter if you're over or under age 55 as it used to. It doesn't matter if you take the money and buy another home as it used to. It's strictly 2 of 5 years used as your principal residence. $250,000 is excludable if you're single. $500,000 on a joint return. That's a tremendous tax break for it. Again, especially benefits older people. So that's the tax consequence on selling a principal residence. When you sell a rental property, here it gets a little more interesting. I'll give you a quick example. There's no exclusion, as I just discussed. So you might say to yourself, okay, I bought that store building that I rented out for all those years. I bought that building for $200,000, and now I sell it 10 years later, I sold it for $300,000. So you think to yourself, okay, I bought it for $200,000, sold it for $300,000, I have $100,000 profit. No. What happens is because it's a business property and you've taken depreciation all those years, let's just make a number. Say you bought it for $200,000, and over that period of years that you owned it, you took $80,000 of depreciation as deductions. So now your cost for tax purposes, the term that's used is your basis, is $120,000. $200,000 you paid for it. You've taken $80,000 of depreciation, so your tax basis is $120,000. When you sell it for $300,000, your gain is actually $180,000. So what happens basically is you give back the depreciation you've taken. The word that's used is it's recaptured.
Now, if the value actually went down from the time you bought it, you still took depreciation, I guess, if you were able to, but maybe the real estate went down in that area and it's underwater. Do you have to pay on the recapture?
Again, let's say you bought it for $200,000 and you took the $80,000 of depreciation, and now you sell it for $150,000. So again, in your mind, I bought it for $200,000, I sold it for $150,000, I have a $50,000 loss. In that example, you actually have a $30,000 gain.
So the bigger the loser you are in value, the
more depreciation, whatever you've taken in depreciation, when you turn around and sell the property, again, you basically have to give that back.
But at some points it could be a wash or something.
It could be a wash, but if you're taking a substantial amount of depreciation, you'd have to have a pretty significant loss in value for you to still have a loss.
But some parts in the country,
could happen.
Things have turned sour.
It could happen.
And what if what if you don't realize anything on the deal? Let's say your property's underwater. Do you have to pay, and you get a forgiveness by the government or a bank or someone? Is that forgiveness taxable?
Okay, so there's a special exception in general, debt forgiveness is considered income. But there's a special exception for principal residence the debt forgiveness on a principal residence is specifically excludable from income. And this was put into law maybe in 2008 or 9 when a lot of people had these losses, so that people who were suffering and losing their home didn't have the double whammy,
a double
having
victim,
to pay
right?
Tax on it, right?
Okay. And is there anything else you wanted to mention in terms of the tax consequences of owning or buying or selling property?
I think we covered a lot of the significant areas.
So I just want to pick your brain as an accountant experiencing these areas. If someone is to try and decide whether it's better to own or rent, whether it's a individual, a family, or let's say a business owner, what things should they keep in mind?
Well, this is a very good question that comes up a lot. Somebody calls me and says, I'm paying $2,000 a month in rent on my apartment, and I'd like to buy something, but I don't know how much it's going to cost me. Can I afford to buy it? So what the answer I give is $2,000 a month in rent costs you $2,000 because there's no tax benefit for paying rent. You do not get a deduction for paying rent on the apartment or home where you live. So $2,000 costs you $2,000. But if you're in let's say a 33% tax bracket between federal and New York State, in other words, you're getting tax deductions equal to about a third of what you pay. That means you can make a mortgage payment, because mortgage payments, especially in the beginning, are almost all interest, as you pointed out before, and real estate taxes are deductible. So you can make a mortgage payment of $3,000. You're going to get a 33% tax benefit. You're going to get basically $1,000 of that back when you file your tax return. This is on a monthly basis. So that $3,000 mortgage payment is only going to cost you $2,000 after the tax benefit. So you can carry a significantly higher mortgage payment than you are in rent and still be in the same position economically because of that tax deduction.
So does it make, from an accounting perspective, does it make sense for someone to buy a house if they're going to be there a year or two, or for a longer term?
Well, if it's going to be a year or two, I would advise people not to buy, because you have significant costs going in, you have significant costs going out, and unless you have very unusual positive appreciation in the value, if for a year or two, I don't think you're going to make that money back.
And I guess the hope is also the property will appreciate, and that will be some kind of gain for you down the road.
Well, especially over long periods of time, real estate traditionally appreciates, but you could time the market wrong. There have been time periods when properties actually have declined in value.
And what if someone's trying to think about whether to buy versus rent a store or an office, or let's say a commercial property? Does the same thing come into mind, or what should they consider?
There you have to, in a business, your capital can be employed in many ways. If you're a store, you may be better off putting your capital into buying more inventory than into buying a building, because you're going to make more money turning over your inventory. If you're a manufacturing business, you may be better off taking your capital and buying machines, because that's how you're going to make money, than putting that money into a building. Again, a business has many needs for capital, and sometimes buying a building isn't the best use of that capital, because the business can put it into something that will generate more income for it, more revenue.
And if you thought that area was going to appreciate, for the real estate value, for the future real estate value alone, that might change the calculations a little bit?
It might. Again, you'd have to figure out how best to deploy your capital. One thing I just wanted to mention, if we have a minute left.
Sure.
There are several new tax proposals. The House of Representatives has one. The Senate has one. It looks like something's going to happen. There are a lot of variances between the two proposals, but the things that seem consistent are, number one, real estate taxes. The deduction for real estate taxes are going to be capped at $10,000. So, depending on where you live in Great Neck, you're paying $25,000 in taxes. Only $10,000 is going to be deductible. That's a consistent provision in these proposals.
And what if you have real estate taxes on a second home or a property you rent out a little bit.
Well, again, a rental property is different because, again, you can deduct those taxes against the income. But that $10,000 applies to in full. So if you have two homes, again, you're still capped at $10,000. So you're paying $25,000 in Great Neck, you're paying $10,000 on your second home, you still only can deduct $10,000. The second thing that is significant is one of the proposals reduces. I mentioned before you can deduct mortgage interest on $1 million of indebtedness. One of these proposals cuts that to $500,000. Also eliminates the deduction, as I mentioned, for $100,000 of home equity indebtedness. That interest deduction will be gone. And also no mortgage interest deductible on a second home. So there are a lot of provisions in these tax proposals that are going to hurt owners or prospective purchasers of real estate. It's quite big changes in this area.
And we'll have to find out, but you want to look at the crystal ball and realize real estate may not be as good an investment or provide as many deductions as it does today.
Absolutely. And again, that also has a major effect on prices.
And because there can be a lot of money involved and a lot of deductions involved and depreciation, if someone has property, and especially if they have investment property, a second home, it's worth their while to use an accountant to get the benefit of all these things.
Absolutely.
Okay, so it doesn't cost, it pays.
No, I always, when people tell me they try and do their own taxes, my answer to that, always, I say, do you cut your own hair or do you go to a barber? I think having your taxes done is a little more important.
And also the chances are they're going to reap dividends and multiples of the cost of using a professional accountant.
Many times over.
And they don't want to miss any of these important deductions or any liability they have for taxes.
Exactly.
Okay. I would like to thank our guest, Barry Levittan, for being our guest on Law You Should Know. He's a CPA, and he's with the firm of Rosenblatt, Levittan, Volfus, Getz & Company, right here in New Hyde Park, Long Island. Keep in mind, whatever you've heard has been presented as information only, and you should get real estate and tax advice from your own accountant or financial professional or lawyer. You're listening to Law You Should Know here on 90.3 WHPC, the voice of Nassau Community College, and also over the internet at ncc.edu/WHPC. If you missed any portion of this program, most programs on Law You Should Know and others carried on WHPC are available by searching WHPC on iTunes for free podcasts. Please join us next week at the same time for another program on Law You Should Know.